Welcome to Next Chapter Wealth, where we explore the issues and options you have now after that liquidity event. In this podcast, you will hear unbiased, objective insights from experienced professionals about the range of tools you have at your fingertips to manage your newfound wealth. All right, so welcome to the show, guys. Jay Schaefer and Sam Millward. We appreciate you coming on. I just want to start with Jay. I want to do some introductions, a quick introduction from each of you. If you could give me a quick 30 seconds on who you are, what you focus on. I know you guys are both in commercial real estate or in real estate, but just give me a quick 30 seconds as to who you are and what do you do. We'll start with you, Jay.
Wonderful to join you all today, and I'll dive right in. In a nutshell, over 20 years as a commercial real estate broker here in downtown San Francisco. I'm a Bay Area native, and 17 years ago co-founded our own company. So I'm an entrepreneur, and in the trenches, so to speak, on a day-to-day basis. I love our great city of San Francisco, and looking forward to its bright future. Wonderful.
Sam, how about you?
Hi, everybody. My name is Sam Millward. I'm a commercial real estate agent. I've been in the field for about 13 years. Prior to that, I worked for Xerox Global Services. I actually moved out to the Bay Area in 2001 from Colorado after getting a Master's of Science in Telecommunications from the University of Colorado Boulder. Full suite commercial real estate agent, soup to nuts, industrial, retail, office, land. Glad to be here. Certainly want to provide as much detail as we can for your audience. So looking forward to a good conversation today. Thanks for having me.
Wonderful. So this is a discussion about how people that have gone through a liquidity event, right? They have new wealth in their life. They're in the next chapter. Maybe they've sold the business. Maybe they've gotten their stocks vested for whatever reason. So they have some cash, right? And maybe they're interested in some real estate, right? I'll start with you, Jay. I'm curious, like in the city. You're based in San Francisco. What's the deal flow look like right now?
Wonderful. Things have picked up quite a bit, and I want to preface by saying timing is everything, and related to that, there's really a generational opportunity going on in commercial real estate that affects all of us, and with that comes the wonderful word opportunity. And when I say generational opportunity, the bottom line is we're 37% vacancy. There's still many loan defaults. And if you want to give it perspective, right, the dot-com era at the worst of it got to 22% vacancy, right? And look what happened between 04 and 07, that run up. It was pretty incredible. Of course, then the Great Recession. And what I mean by saying all that is we've been a long cycle of boom and bust here. And for any investor that's bought low and be able to hold on or sell high, they've made a lot of profit along the way. And the generational opportunity is in the neighborhood of a 70% discount now. Now we're seeing that deteriorate little by little. And what I mean is the discount is deteriorating as prices rise. So I think the window of opportunity is closing, and I think over the next year, there's still going to be so many options for any savvy investor that's looking at commercial real estate and take advantage of, whether it's in the city here proper or with Sam in the South Bay. This Silicon Valley area has so much optionality as far as what people can look for, price ranges, locations, you name it, product types, and you've got some real experts here to weigh in on that.
Yeah. So Sam, since you're kind of based South Bay, I used to live in San Jose, by the way, so I'm familiar with all the really good burrito places in San Jose. Maybe there's a burrito restaurant available. Anyways, I'm thinking, what's the deal flow look like in South Bay? How does maybe types of properties, commercial properties, are slightly different than they are in the city?
Yeah, just kind of trying to riff off of what Jay just articulated. He gave your audience a bunch of different deal points that I think are relevant. I would add though that in looking at San Francisco as a market as it relates to the peninsula and the South Bay, while everything is still heavily discounted, I couldn't agree more that it's a good time to be looking into this and making decisions because of the discounts. San Francisco has been hit harder than the peninsula and the South Bay. That's not to take away from anything that he's saying, and he's also, when he's talking about discounts, it's across multiple different asset classes. It's when he's talking about vacancy, he's talking about office as an asset class. Most likely, I'm making an assumption there. But of course, underneath the commercial umbrella, you've got office opportunity, you've got retail opportunity, you've got industrial, and a subset of that is R&D. You've got land, and kind of in the gray area, you've got the apartment buildings that are more than 4 units typically are considered commercial. So for me, in coming into this discussion with you guys, I'm picturing like it's such a great offering for your audience who have come into a new chapter in their life. They've probably, whatever liquidity event happened probably wasn't easy. I think looking at yourself as an investor, are you someone who's really hands-on and you want to take on a new project? Like commercial has that for you because it does take a lot of oversight generally. In JLAD, there's opportunities out there that are just, they're kind of on autopilot. You can get a triple net leased investment, which is everything's sort of handled for you. They call them coupon clippers because you're getting checks in the mail every month. What I'm talking about there is like a Pizza Hut or a Starbucks where you got a grade A corporate tenant that's leasing space and you're the property owner. But I really like this idea of someone who is turning the page in their life and has some money to spend or some assets to deploy, and commercial real estate offers great returns. You're in a market that has just incredible opportunity, in my opinion, from a commercial real estate standpoint. There's not a lot of development going on because we're surrounded by water and there's not a lot of urban sprawl. But if you want a hands-on project, it offers that too.
Mm-hmm. Really quick, guys, before we go any further, I just want to make sure we all have our phones on focus mode or airplane mode, just in case somebody decides to call, ask about viewing a property. Totally possible.
So Sam, would it be a good assumption, and I'm going to take this to a second step in the question, to divide the buyers in the world out there to institutional, and then family office, and then private wealth? And if so, as you look back on the fourth quarter and the third quarter of 24, where did you see activity between the different property types on those three types of buyers? Can you give us some perspective, Sam?
I'll go, but I'd like to give Jay a chance too to answer that. It was really slow for me in the peninsula and in the South Bay, especially on the acquisition side. I mean, the more you kind of dug into things being bought and sold, the more you uncovered that banks were slow to lend, and sellers were kind of waiting to get through the election and the holidays and stuff like that. I think that all factors into it. Surprisingly for me, most of my activity was around leasing across a couple of different asset types, office and retail, towards the end of the year.
Yep. And tagging on, well said, Sam. In San Francisco, the buyer profile is night and day now to what it was 6 years ago. What I mean by that is in the world of office and flex properties, and for anyone that doesn't know flex, that's for robotics type companies. Any company that makes a widget would fall into the flex category, if you will. And so to that effect, there are no institutional buyers in office and flex right now. Now, I do think that'll change the next 6 to 12 months. But the institutional buyers that were purchasing properties in the run-up right before COVID have really struggled mightily for the most part. Some are doing okay, but a lot of them have struggled. And so to that effect, the buyer profile over the last couple of years have been mostly family offices, small real estate development companies, and owner users. So the private wealth component, so to speak, is a growing asset class relative to who the buyer profile is. Take two examples as case studies here. 400 Montgomery recently sold in Q4 late last year, as well as 500 Washington, both of which were small real estate funds relative to the institutional category. And so that buyer profile is night and day, but one of them included a syndication. And so within private wealth, you get into the concept of control. Do you want to have the entire asset to yourself, or depending on scale, do you want or need to syndicate the property? And so the syndication component is growing as well as far as what opportunities. And then you have smaller investors as well, such as owner users and nonprofits that are coming in and buying buildings. Look, 6 years ago, a lot of businesses were pushed out of San Francisco in the run-up of all the peak pricing about 6 years ago. Now prices have come down, as I said before, on average 70%, and that's created a window of opportunity for a lot of people and investors, but also nonprofits who have been gobbling up property after property. We just sold in the fourth quarter property in West Soma, and West Soma is not where most businesses want to be, but for a nonprofit, they love it in the city, and it works out well, and they get an affordable building. And that building sold for a 60% discount, and so that nonprofit now can own it forever, hopefully, and they'll be there for a long, long time at a very affordable sale price.
Give the audience just a little bit of color when you use the term syndication, Jay. Kind of tell people kind of what that means.
Yeah, wonderful question. In this particular circumstance, when a building sold for over $30 million and they looked at what the debt market is like right now, which is extraordinarily challenging, right? So Sam already teed up that nice softball, right? It is not easy to go get a commercial loan right now. We're not just talking about interest rates, it's all the requirements that come along with it. And so to that effect, they had to raise a significant amount of equity. And this particular buyer, which happened to be Redco, decided to syndicate it. And what they actually did was they did friends and family first, and then they actually offered it to the entire San Francisco brokerage community. So any broker that wanted to get involved in San Francisco that knew about it, such as myself and our team, we had the opportunity to cut a check, if you will, and become a joint venture investor in Ford and Montgomery. I mean, downtown core location sold for $300 a foot. That actually hit the nail on the head for us, that 70% discount, because buildings 6 years ago on average were about $1,000 a foot. Pretty remarkable. But they didn't want to spend the $30+ million in cash themselves, so they went and raised a portion of that capital from the investor community in the region.
And
Sam,
Sam, is that happening down the peninsula also?
Yes, I'm sure it is. No, I'm sure it is. With everything that he said is happening up and down the peninsula, I just think 70% off from, Daly City down to Morgan Hill. I think that's a little bit on the high side, but we covered that already. We're still talking about significant discounts across most classes, I think, of asset, with the exception of industrial. I think industrial's held relatively firm, but Jay's obviously the expert in San Francisco. I look at San Francisco as sort of an outlier statistically, just because it's been hit somewhat harder. Great question about the syndication, too. I think that's a great clarifying question.
I'm curious about, okay, so this is, I want to get to this locations that surprised you guys, but Sam, I'm curious about, is there a non-obvious reason why banks are hesitant to make loans at this point, or is it all just they're worried that there's not going to be any tenants?
I think there's a lot of things that banks look at. If you've ever gone through a refinance, if you've ever tried to get a loan, just a personal loan, they look at a lot of different things. They're trying to protect themselves as best that they can while also securitizing the loan with a piece of Silicon Valley real estate. I think my personal opinion is, especially last year, leading into sort of the election season, I felt like, at least for me, started early. I also feel like consumer sentiment in the banking sector was really low for 2 years. You talk to lenders and they're just can't get any deals done, and there's attrition and people are changing. Tenancy is obviously an issue on the investor side. I think clearly, if you're an owner user, which I think for me is the most exciting part of commercial real estate, where you're helping these entrepreneurs that are just these super smart people moving from a leasing situation into an ownership position. When the interest rates go up and sellers don't want to come down in price, which always is a lagging indicator, owner users can't make the numbers work. And so you see less applications, you see less SBA lending, and it's really a complicated answer, but I think the winds are shifting. I think now that the election has been decided, I think there's less fear and uncertainty and doubt in the market. I think people who are fast movers, fast to market, align almost directly with what Jay said earlier, which is it is a really awesome opportunity to start looking, if you haven't, start assembling the team of advisors that you would need to make a really smart and informed decision, and really understand yourself as a buyer or an investor. Do you want to be a hands-on, do you want to take on a new project as part of the next step in your legacy, or do you want to look at commercial real estate as just a pure cash-on-cash return type investment? And then from there, you can start looking at, because there's been tools that have been designed that have made it so easy for guys like Jay and I to look at deals in like strange places, like leading to what you're kind of talking about. You know, the MLS services that are available now, you could tell me an address and we can go in and take a quick look at it, and then we can also, using the same tool, identify brokers inside of that area where you could get the boots on the ground if you feel like that's necessary. So lending is an important component, but I think timing and fit are the two most important things as you proceed.
Can I add on to that too? For those that don't know, I actually sit on the board of Bank of San Francisco, and the real local relationships that happen in cities like San Francisco, or for you, Sam, in the peninsula, the reality is those relationships and information are meaningful and a huge component of it. And I'll give you an example. I'm not going to try to put any bank down, but it's a war story that I think is helpful. One of my clients, Russian Hill Academy, a private school in San Francisco that we sold a building to, wanted to get a commercial property. They teed it up with Chase. And JP Morgan botched the process more than I could even, believe would even be potentially possible. And so through that process, my client came to me, in the middle of the escrow and said, Jay, we have this real issue with Chase. We thought we'd get it done. The underwriters have all these requirements. We just can't meet. What do we do? Who do you know? Are there any doors you can open? I made a very quick introduction to Bank of San Francisco. Shameless plug here, but the reality is they got it done. And those local banks have a very different mindset than the institutional banks. So if you were to go to the Chases and JP Morgans of the world and say, here's what we need, right? Can we get it done? Maybe they can help you sometimes. I'm not saying that they're always bad by any means, folks. But in the same vein, the local community banks who have more of a relationship-based mindset will often modify some requirements and do some different deals, and it doesn't have to fit in the proverbial box. And I like that creative mindset and approach where, in this case, the relationship we had was meaningful.
Yeah, can I add on to that? Because I think there's some real wisdom there. It all lines up with assembling the team of resources that you need. I can't tell you how many times, how many clients over the last 13 years I've talked to that it's been years since they benchmarked their bank. It's been years. The bank has had multiple different advisors come and go, come and go, come and go, but they've never changed. And so I always advocate, I think you need to assemble financial advisors that you know, like, and trust. I'm betting that you got I think Provisors is a great resource for this, by the way, where you have your accountant that you trust. You've got your commercial real estate person that you know that you can trust and that you can work with, because these deals get somewhat, for lack of a better term, they get troublesome and intimate. You're giving them access to a lot of information. Lending is no different. I'm not at all surprised to hear that Jay had success shifting from something like that bank to more of a local relationship-based bank. But would you know that if you didn't have an advisor telling you that? You'd probably just be like, well, if Chase can't do the loan, they're JP Morgan Chase, and oh, by the way, they just absorbed First Republic probably around the same time. Mm-hmm. So what do I do? It's all about who you surround yourself with, period.
That's really interesting. I want to go down the road of the new locations. Jay, you were talking about how some different types of deals came through this year, and I think that was more on these flex categories. I don't know if that's a specific type of location, but I'm curious, are there any different pockets of San Francisco that are emerging that you're like, wow, I didn't see that coming, or that you're like, I'm really glad that is developing as a market?
Wonderful. I'll answer that, and I want to add to it as well. So in Dogpatch and Potrero Hill in San Francisco, we call that area AI. The bottom line is a lot of AI companies, not all of them, but I would say, you got ChatGPT, parent company, OpenAI, which is the parent company of ChatGPT, down in Mission Bay. But they started basically a little bit west of there. And what we find are almost all the AI startups want to be in OpenAI's backyard. And so to that effect, you have Potrero Hill and Dogpatch that have been up-and-comers for the last couple years now, and it's boomed into a really, really wonderful neighborhood now. And you have schools and parks and public transit, et cetera. There's a lot to love there as well, and the amenity-rich environment. But it's for a younger class that's very much tech-central, but investors that want to piggyback on the AI boom that's going on in Silicon Valley and specifically in San Francisco should definitely consider Dogpatch and Potrero Hill. And you can find smaller and mid-sized buildings there where the sale price is so relatively affordable. There's very few institutional-sized properties in those locations by way of detail. In addition to that, Hayes Valley has done it tremendously well. And one of the bigger opportunities, if you will, is Jackson Square. So Jackson Square has long been beloved for anyone that doesn't know the city that's just north of Transamerica. And Jackson Square submarket has beautiful brick and timber style buildings, generally speaking 2 or 3 stories in our world, relatively boutique. And we're seeing a number of owners default on their loans right now. And with that new opportunity, right, opens the door for investors to get into that area, which traditionally has not seen much decrease in their sale price expectations. But we're seeing a lot of opportunities now open up in Jackson Square where historically that just hasn't been the case.
Sam, any perspective, spots, types of properties, spots as you kind of creep south?
Am I surprised? Is what I'm hearing is the question. Not really. I think a lot of these towns, a lot of these cities are investing into their skylines, if you will. I think one of the ones that always surprises me is Redwood City. I come down there and there just is constantly more and more growth in the Redwood City market. I think sometimes I get a little caught off guard at how expensive the commercial real estate in Morgan Hill has gotten, which is further south, especially when I see how traffic patterns are. But nothing comes to mind as being like, wow, I didn't really think of that. And I think it's because, to be fair, I am so impartial to real estate in Silicon Valley. I think if you look at commercial real estate inside of Silicon Valley as compared to most other areas, maybe Manhattan and New York, I just kind of feel like it's really very, very valuable. They're not making any more of it. I feel very fortunate to have this market drop to be working within, if that makes sense. And as an investor, as your clients, Mike, I think that's how it should be looked at. There's a reason why these prices are what they are. And we talk about different industrial booms. You know, a few years ago it was this huge Google push. Well, they're starting to anticipate. You've got AI doing just incredible things you can't even put words to. And then somewhere down the road there's going to be a big jump from the biotech sector, which I think is going to have massive impact on South San Francisco and Daly City and that area. So I just kind of feel like, to me, I feel like, and I am a glass, for your audience, I'm a glass half full guy. I feel like we're in a rubber band moment. And the rubber band just keeps pulling back, pulling back, pulling back. And we saw a very similar thing as we came out of COVID. You know, there was a lot of depressed demand. And when COVID started to recover, I mean, Jay, I don't know if you can, agree with this or support this, but I just remember coming out of COVID and all of a sudden there was so much transactional volume. You almost felt like you were late to the party. Surprising places, not really, Mike.
Yeah.
You want to talk about partnerships?
Can I add to that, guys? Sorry, I didn't want to cut you off. So just to add to that, between 2004 and 2007, right, investors would have tripled their money buying an office or flex property. Doesn't matter if it was a San Francisco or Silicon Valley, right? The reality is the run-up, right? As Sam, I love that rubber band concept, right? I don't think people in 2004, when the office vacancy rate in San Francisco was 22%, could visualize that they could triple their investment in 3 years, right? And right before the Great Recession occurred, it was pretty damn frothy in San Francisco. And if you were to go to the next cycle and say, all right, if I were to buy in 2009 or 10 in the depths of the Great Recession when very few other buyers did, and sold, 5 years later, 6, 7 years later, again, you would have at least tripled, if not more than tripling your investment. And it's really that timing is everything that I wanted to highlight. If you had to have my best guess, 6 to 12 months or so that we still have left. And that's about it, folks. I think if this were a baseball game, we're in the 7th inning, right? We're pretty deep into the process, and the recovery is well underway. One statistic to help prove that, if you will, San Francisco last quarter saw its first quarter where demand exceeded supply. We call that positive absorption. So we had our first quarter of positive absorption in the last 5 years was the last quarter. Now I'm going to expect a pretty bumpy road. I don't think it's a vertical recovery here, folks. I'm not going to oversell it by any means. But in the same vein, that gives a lot of people pause and optimism that things are starting to change, and we're really at the tip of that. So get it while you can, folks, and there's still a window of opportunity for those that want it.
Okay, so I'm going to ask a question, a little bit off script, Ryan, but I'm going back to this high net worth investor who has just exited, has a pocket full of cash, but really not enough cash for California real estate, or not enough of a percentage of cash for California real estate. Jay, you alluded to the syndication, but there's also partnerships that are put together all the time. If I'm that person, that lady or that gentleman who is sitting in that situation, and I want to buy, but I don't have the bandwidth to go out and buy a property myself, how do I think about putting together a group of people?
Yep. I'm going to go back to what Sam said earlier. Build that team, right? Who you surround with is meaningful. You need a great wealth manager, or Mike, right? If you want to look at Peninsula, you got Sam. You want to look at San Francisco, start with me. And then consider us the quarterbacks, right? And that quarterback model is based with, look, there's going to be attorneys involved. In San Francisco, you get zoning issues, that's land use, right? Legal support team, you need contractors, you need architects. There's all sorts of codes that get triggered along the way if you're renovating properties. And one of the unique things, and what I love about our company as well, is I call it vertically integrated. Some people would say that's turnkey or full service. And so we can help broker the deal, but we also help manage the building. We then help lease it up. So we don't just sell the dream, we actually help on executing it. Now, we don't force people to use those services, it's optional. But the point is, we can help you broker it, manage it, and fill it if you want to use that full array of services. Now, that said, we surround ourselves with experts. So whether it's architects, contracts, designers, legal experts, wealth managers, insurance, etc., that's really meaningful and can make all the difference in the world. When you open up the door and the kimono to that, we get a real conversation with people, to answer your question, Mike. And if someone says, hey, they need help partnering, we have a list of people that have already expressed that interest. And that information and those relationships are meaningful to opening the right doors for that individual or those investors that need that support.
Gotcha. Sam, you have input on that?
I just want to amplify, if you're listening and you just need to hear what he said there, which is surrounding yourself with the right people. And I think the fact that his company can vouch for a lot of these different things is hugely advantageous. Knowing people and how to get things done, it doesn't matter if you're in a huge metropolitan area or in a small town. Some of those thematic issues remain consistent. I would add, in your case, when you said that, I pictured somebody, and I think if someone were really serious, Mike, you would definitely want to get an attorney involved to counsel you on how to create whatever structure makes sense. But to me, you almost want to have the property identified first. And I hear Jay talking about Jackson Square and those buildings, my ears perk up because I love real estate. I get excited about commercial real estate. I get excited about office buildings that are brick and wood and that have been around this area for generations and generations. If you're that investor that finds a piece of property, your conversation going and get syndicated partners becomes a lot easier because your passion's behind it, right? And the conversation gets a lot more powerful with guys like Jay and me because we're like, oh, here's what this person needs. Here's what she needs.
That's really helpful. That's a really great idea. I hadn't thought about it.
And there's free resources to do it, Mike. You can go to a website called LoopNet, LOOPNET.com, and if it takes you more than 45 seconds to create an account, it's like,
You're
call
doing it
me
wrong.
or call somebody. You put your email in, create a password, and you're off and running. They need to make money too, so you're only given certain access as a general browser, but you can look at markets and you can speculate, because where I thought you were going, Mike, was what are some speculative markets outside of California, which I love having those campfire conversations, of course, but your audience can go and start doing some of the research first, and if they find a building that they really, really like, I think that's a real
Makes sense.
I got a question about, so say somebody's, maybe they're in the audience and they're not from California.
Yeah.
And they're like, well, I only invest in Turkey and like West Virginia. Why would I want to consider California, right? I have all this money. I've made my millions. Maybe they've never been to California. Like, what's the case for California itself? And I'd like to get it from both your guys' perspectives. So, Sam, could you just give me like what's the general case for California as an asset class in real estate?
Well, I kind of had an answer to your question earlier. I think for that individual in the hypothetical that you subscribed, I think the most ideal investor that you would want to invest things that you know about. So in the example that you gave, I would probably counsel against it. Yeah, sure, go look at the free information. It's free. Go look and see if there's something that's exciting that gets you fired up to do something in California. But if you know Turkey, as you say, or you know a certain thing, and that's your thing that you've spent years, maybe decades learning about, leverage that to your advantage. In terms of California as an investment area, I don't think all of California is. I think that there's areas of California that I would absolutely steer clear from. But the San Francisco, Silicon Valley Bay Area, I think, is very unique. And if you can get in at a time where prices are like generationally low, just on that merit alone, you should look at it. Just on that merit alone, you should dive in and you should look at it. Because there's a lot of stuff that has to happen before you actually record a new piece of property between that and, recording. That's how it is.
Can we have a quick conversation about risk and return, right? Because I do agree 100% there are parts of California I definitely would not recommend investing in, but I think it all boils down to risk and return. And just by way of example, quick conversation about cap rates, right? It's the unlevered, so no mortgage return on a commercial asset. And so if a cap rate in California is, let's say, 4, 5, 6%, somewhere in that general range is where we're seeing net return on commercial property unlevered, that pales in comparison to out of state. But then you get a lot more risk. So just by way of example, you can get a triple net property in some other state that's somewhere between 6 and 9.5%. So if somebody wants to chase 7, 8, 9% returns, that's more of a coupon clipper and just looking for a higher cap rate, if you will, definitely probably looking out of the state. If you're willing to look at stability as a different mindset, or you're willing to roll up your sleeves and operate a property or hire someone like our company, myself, to operate the property on your behalf, there's a lot more upside potential. So I wouldn't necessarily recommend San Francisco and Silicon Valley for the coupon clippers. For people that are really willing to get into the trenches, roll up their sleeves, look at how to add value, and if you can find those value-add properties, that's where you can really double, triple your money over some period of time and do a lot better than you can in alternative asset classes typically.
Mm-hmm. And I also think that there's something to be said for maybe some clients that want trophy assets. Yeah. They're big on having that building in downtown San Francisco. They're big on having that retail location in Palo Alto.
Well said, Sam.
Yeah, I think that's a cool point because maybe they do just like those iconic places wherever they are. And that's a great segue to another question I have. It's not on our list, but I remember going to some VR company. I lived in London. This guy owned a VR company, right? He had VR headsets, and he's like, this is going to be great for real estate. And probably it's a good for like residential, but I'm thinking like from a commercial perspective, are you guys seeing any new technologies that are being used to showcase the properties for out-of-state buyers?
Yeah. Well, how's this? Since the beginning of COVID, virtual tours have boomed, right? Nobody really in our industry 6 years ago knew what Matterport is. Matterport's hardware and software technology that creates virtual tours. So you can see the space without actually having to be there. It's very different than, let's say, a video that you put on YouTube or whatever platform. The bottom line is a Matterport, you can actually click up, down, left, right. The VR side of things is more rare, right? And that's with larger buildings or developments where people, let's say, can't necessarily touch it as easily. In a future development, they want to have renderings, and those renderings are being translated to VR more and more often. But we're seeing that pretty much only in new development for the VR side. However, in existing assets, Matterports and virtual tours are prolific, and that's made our entire industry more efficient.
Totally agree. I would only add, just because you asked, is recently I've been playing around with AI. A friend of mine who's an AI guy who I was going for a listing on a building that had a bunch of deferred maintenance. Needed to be fixed up. It had a bunch of stuff that needed to be fixed up. The sellers didn't want to deal with it. So I challenged him. I said, well, if AI is so great, run it through this. Run it through your AI, whatever it was, and send me some renderings of what it would look like after all of the deferred maintenance was taken care of. And he did it. And it came back, and it looked like, you could tell it wasn't an architect's rendering, but he did it in like a day. The other thing I just recently saw for the first time in like 13 or 14 years doing this is a company offering virtual staging for commercial assets. Now you're probably thinking like an office basically, right? But you have this vacant office where you virtually stage it. So they're layering technology over the picture to make it look like it has chairs and pictures and a guitar sitting in the office, whatever. But I would totally agree that the virtual tour for out-of-state people allows you to walk the premises on your phone too.
So that's a great segue. My sense is that all that work is being done in a data center somewhere. All that artificial intelligence is cooking in some server in a data center. Are those kinds of properties? Strikes me that they would be out in the middle of nowhere, close to a power source, as opposed to somewhere in California. Is that accurate, or are those kind of newer types of properties? And another area that this kind of trips on is the biotech space. Are you seeing unique types of technological applications to buildings in terms of who the renter is and what they want in those buildings?
Yeah. So first off, on the data centers in San Francisco, few and far between. There's a couple, right, for obvious reasons, right? We're in earthquake territory here, right? And so it's not rocket science to say, do you really want a data center, anywhere along, the fault line in California? And so to that effect, 95% of the data center developers choose out of state for that very reason. There are challenges with the construction costs right now in the Bay Area, and I would say that's one of the sore spots. Is it's extraordinarily expensive to build, and that's affected both, let's say, repurposing properties or adaptive reuse of them, but it's also affected, let's say, residential conversions. And a lot of people say, oh, got all these office buildings have vacancy. Why don't a lot more of them get converted to housing and residential? The problem, well, two problems. One are construction costs, and the second is cost of capital. So it's not cheap to go get a loan, and it's also very expensive to actually build it. And so the math just is upside down to convert most buildings to residential. I think we'll see 1, 2, or 3 of those at the end of the day in the next few years, but I don't think we're going to see a tidal wave of properties converted to residential. However, biotech buildings have done extraordinarily well in the Bay Area. And I do see that as a beloved asset class. Now, operating a biotech building is entirely different than an office or flex building, so it takes a certain amount of expertise. And so for, let's say, someone that hasn't done that yet, I wouldn't advise that they go down that road in the near term and build that expertise over time. But for a certain sophisticated individual that has the expertise, by all means, biotech has done very well and will probably continue to do so.
What are the qualities of a biotech building?
Oh, good question. So there's a few requirements. There are electrical requirements and mechanical, which basic HVAC for layman's terms. The requirements for mechanical, ventilation, and electrical are night and day to what an office building would require. So let's say you had an office building that was largely vacant and said, I want to convert it to biotech. You would have to call PG&E and deal with them for 2 years?
That sounds great.
Right, yeah, to increase the electrical capacity, and that's not including all the other work that's required, such as additional ventilation requirements to get whatever's going on into the biotech space out in a safe manner, as well as the mechanical upgrades required as well. Clean rooms and the like are not easy to build nor cheap.
Yeah, it's got to be like totally sterile and everything, I'm guessing, something like that maybe.
Exactly, correct. It's just very costly. And so to that effect, it doesn't always pencil.
Sam, my sense is more that the biotech and other kind of unique properties occur as you drive south on 101 primarily, not 280, but 101. Is that accurate?
In a general sense, yes. I wanted to say too, like yes, it is. As you move further south, there's larger swaths of land, more data centers and things like that, of course. I thought you did a great job answering the question about the biotech stuff. I mean, it's a general question, but the only thing I would add to that is that, there's a lot of oversight, federal and local oversight that require privacy issues, different things that just translate to more dollars for the tenant or the owner of the building. Back to the whole residential thing, I get to that question a lot, and it seems from a cost perspective that it's very cost prohibitive, but I do like what they're doing with some Costco's. Have you seen this, where they're building residential units above Costco?
Oh, imagine living there.
Yeah, and I like it because, and I did a little bit of research into it because Costco's a dividend stock, and so I kind of like dividend stocks. I was wondering if Costco actually owned the development of the residential units that go on top, and they actually don't. It's a developer that comes in and partners with it. So the thinking was, marrying a new income stream to a dividend stock seemed like a smart thing to look into. But it turns out that it would. But I really like how that pencils out, because looking at the warehouse of Costco and then building the residential units over it, Costco's typically have tons of parking, tons of infrastructure. It's probably not going to be a huge adoption rate, but it could signal other warehouses. There's Sam's Club, and there's all these other different
IKEA
types of huge warehouses where maybe they found an economy of scale that they're willing to invest some money to try to profit from.
That's a very innovative, kind of residential / commercial play. How interesting.
So we probably ought to kind of finish up this piece of it, Ryan, time-wise. You want, so one of my questions was, I think already answered, which was, what have you seen in the last 6 months that either of you guys said, wow, that was a creative way to put a deal together? You got something on that end, Sam, where a deal was put together in a way that you didn't see coming?
They all are that way, really. I don't see a lot of deals. In fact, I see very few deals, with the exception of some office lease deals that are similar in nature. Most deals are complicated in their own right and require, and that's why I think one of the main really differences between commercial and residential is, on the residential side, you're a home buyer, you buy a home, you write the purchase agreement as the offer. Here is the purchase and sale agreement, sign it, we're in escrow. 45 days later, if that, the property changes hands and records on title. In commercial, it's much different. It starts with a discussion, there's an offering memorandum, usually numbers are involved, whether you're an investor, owner, user. Then there's a letter of intent that usually gets circulated around and around, focused on the business terms. Then there's a negotiation on the purchase and sale agreement, which is typically longer than residential. And that's because you have to get creative in almost every deal that you do.
Jay, I got to believe you got something on that.
Yeah, to be candid with you, if you had said even 6 months ago that the brokerage community in San Francisco would have a chance to do a syndication of a commercial investment property, I would have, thrown you out of the room. I would say, no way. So just by way of example, what Redco did as a new concept to buy 400 Montgomery and syndicate that in such a broad manner to industry experts really blew my mind at the time. Now, we've seen syndications again and again. It's just not usually done in that way. And it was very well received, a bit of surprise, and it could very well bode to more and more of those in the future.
Right. Makes sense.
All right. Well, we've covered a lot of ground from a commercial real estate perspective. I'm taking some notes here. I'm learning about the importance of using community banks over larger banks when the occasion comes up. We learned about the new types of places in SF, specifically, what was it called? AI. I like the
Area AI.
And the importance of using a team. I love the thing, the Costco living is so fascinating to me. Just living, imagine all the chicken possibilities. New types of syndications.
It means you're infinite.
Do you guys have questions about wealth management or marketing, things like that?
Well, how's this? How does a wealth manager, you're the expert, Mike, talk to your folks about commercial real estate investments, whether it's Peninsula, whether it's San Francisco or the like? How does that fit into the average portfolio, or even if it's not the average, to the new modern way of thinking of diversification?
Well, I would say the succinct answer is hedging one's bets. We've had a 2-year run-up in equity markets. Those things don't usually last forever. So let's hedge our bets. That's one reason. The other thing, and I mean, this is something that I have the luxury of speaking on, is what I will tell a new client is I will invest your money the same way I invest my money. There will not be any difference between the approach I take and the approach you take. And, I own commercial real estate. And I tend to think, it's a good hedge, but also, other than what you just said, Jay, about prices being down, this isn't something that people talk about in a dynamic fashion like equity markets. So my belief is the way you smooth out your returns is you own multiple different asset classes. You own stocks, maybe you own some bonds, you own real estate. You own a business, and that's kind of the way to smooth out your returns over time. That's my perspective.
Love it. Well said.
Any other questions for us? And if not, Ryan, I think we got a wrap here going on, unless you guys have anything else.
I'm happy if you guys are happy.
That sounds great.
Thanks again,
All right.
you guys.
Thanks, everybody.